Hello everybody, so this video is brought to you by my Patreon. Some end of year questions. I received more questions than I can handle. I selected a few at random. If I have time, there will be a part 2 if I have time. If not, whenever I do another Q&A, please ask the question again. I try to not answer them multiple times. First question today on the Patreon was SpaceX, the SpaceX question. So you do know I have some exposure to Rocket Lab via Leaps, because that's the only 100% pure play exposure that I have, because we can't buy SpaceX. Unfortunately, the SpaceX exposure has to be indirect. And so this Patreon member asks, well, what do I do with SpaceX? Because, I do want to have exposure to the other big Musk company, the number one company in space. And space is likely going to be one of the next big mega trends or big sectors. How do I play SpaceX? I play SpaceX via Google. Google all the way. One of the first videos on my channel was, back still in the day when I used the avatar. One of his first video, I talked about why I own Google, and Google owns about 7% of SpaceX, if you didn't know that. That's what they own, and I think Google is the best way for me to play it. Additionally, Google it's slow growth. It's kind of a VC firm at this point because they own so many different things. They have a fun portfolio of future things, of future megatrends and mega sector. You may remember a few days ago the news on quantum, weeks ago, I guess it was 2 weeks ago, the news on quantum and their new quantum computer. They are one of the big three cloud service providers with Google GCP. They have YouTube. Gotta ask yourself, what would YouTube be worth if it was a standalone business? Probably a lot of money. Same for Gmail, same for Chrome. How much would these businesses be worth if they were standalone? They have Android. Sure, Android is open source, but they still get to place their products, to place their search engine, etc. with Android. Android is still a very valuable property. They have Pixel phones. Pixel phones are really catching on, and they may go in front of Samsung and actually beat Samsung. So that's a big business. They have Waymo. People are slowly realizing that this may be worth some money. Being the number 2 player in self-driving may be worth some money. Waymo just became much more valuable as GM Cruise quit. And they have Gemini. Yeah, Gemini is not my favorite AI, but it's still one of the leading AI. And I suppose I didn't mention Google Search because a lot of people say, there's some risks with antitrust and some risk with Google Search being jeopardized by ChatGPT and Perplexity and other AIs. We'll see about that. If Google Search loses value, which I believe it inevitably will over time, that will take perhaps a longer time to play than most people think. I remember this survey from weeks back talking about at top schools, how many students actually use AI at top schools around the world, and it was something like 6 or 7%. So AI is definitely in the workflow of professionals, but it hasn't really reached many young people. It's big, but it's also big because of the people who watch this video and us. It's big among us. It's big among us, internet people, digital people. AI still has to reach the masses. Google is big with the masses. You still have people who are discovering Google, right? And I can think of a handful of analysts who are still finding out about Google, stock analysts. You may remember my video I made about HIMS, how to search on Google, because they didn't know that tirzepatide was not sold by HIMS. Anyways, enough with the funny question. You asked in this question, my Patreon member here, you asked about Destiny Tech. I've answered that question in a separate video 8 months ago. Short answer is I prefer Google. It's fine. Destiny Tech's fine, but premium's too high for me. I don't like to pay a premium. I prefer Google. And I also answered the SpaceX question via ARK Invest. And I know a lot of people hate ARK Invest. ARK Invest is kind of like a mini China. When you hear ARK, a lot of people say, no, I would never touch it. But they do have a venture fund, and they own 12% of SpaceX in their venture fund. And their venture fund trades every quarter. It trades at the last official redeem price. And so SpaceX would actually be updated up in private valuations in that fund. Noteworthy in the ARK venture fund, They have SpaceX, sure, that's fine, but they have a lot of very interesting names like OpenAI, like Anthropic, like Figure AI, like Databricks, right? Databricks. Many people love Databricks. They say it's going to be a big competitor to Snowflake and Palantir combined. Just that. Well, there's exposure to those in the ARK Invest Fund, but a lot of people have just given up on ARK, and so it depends on your own stance on that money manager. Moving on to question number 2. Question number 2 is a two-part question. So one of them is, as a YouTuber, would I consider covering top stocks that are covered by much bigger YouTubers? And well, first of all, I'm very grateful about the 14,000 subscribers I have now. This is amazing. I'm so happy about it. Thank you so much for subscribing if you already do. But yes, I think now I can probably cover more of the mainstream stocks like SoFi, like Palantir, like Tesla. And I intend on covering them more, especially Tesla. Palantir, we'll see what I do with Palantir. I have the urge to sell Palantir once in a while, as I'll cover in my response to another question in the Q&A here. Question number 2 here is about the small gems. Should I cover more small gems? Well, I do cover a few small gems. LifeMD, I've been buying LifeMD. If you're on the Patreon, you know I've been adding LifeMD to my portfolio. I like LifeMD very much. I call it a mini HIMS. I like BSEM, BioStem, BSEM. I like that one too. I'll cover it in a second, so let me not talk too much about that. I've covered another small cap in the past, which was Lovesac. It was a couch company that was beaten down. So that was a former favorite. I never pulled the trigger on it, never bought it. It's been flat. It's been flattish. I need to cover more small caps. I will cover more small caps. The problem with small caps is the lack of information. There is so little information on small caps. Point number 1. Point number 2, another problem with small caps is they're not available on the more modern brokers, like Robinhood. Like I can't buy BSEM on a Robinhood app. I can't do that. Many brokers don't have it. Only the old legacy brokers have it, and you have to pay like $7.99 to buy it or something. Anyways, I don't like that about the small caps, but I should. Sometimes alpha is to be found in small caps. Question number 3, how do I approach company research? How do I research company? Well, first of all, I will say researching a company is very tacit. It's a very tacit process. It has to be a hobby. It has to be a passion. There's no written down process for me. It's a passion. It's a hobby. It's what I do in my free time. In my free time, I pick up X. I have X on my phone, and I follow a bunch of people. And sometimes I see an interesting stock. Sometimes I'll scroll 10 pages of X and I'll see something interesting and I'll click. It's very organic. It's very tacit. I would say the number 1 source of ideas is X. Second source, this is my see, I'm a little legacy, huh? This is my legacy source. My legacy way is Seeking Alpha. Now, Seeking Alpha, you might find it strange because there's a lot of dividend investors on Seeking Alpha, but there is a small portion of Seeking Alpha was about growth investing, and I found some ideas on there. Finviz is my favorite screener. I always have Finviz open. You can use whatever screener you want. There's so many of them out there. I want to use TradingView more. I haven't had the time to use TradingView. I want to use TradingView more. There's so many out there, so much competition. They all have more or less the same content. I would say X is the absolute must. The most analog I'll ever get on this channel is tell you about Seeking Alpha. I use Seeking Alpha once in a while. Specifically, though, if your question is about the numbers, undervalued stocks. So, part of this channel, I cover undervalued stocks sometimes. How do I come up with one? Well, first of all, price to sell. Price to sell has to be under 3. If it's more than a 3, it could be a great stock, like a Tesla, for example, which is like a 7 right now. Could be a great stock, right? But I think Tesla is more than a 7, by the way. I don't recall it off the top of my head. Anyways, could be a great stock if it's more than a price to sell of 3. Could be a great stock, but it's not going to be an undervalued stock. It's going to be an undervalued stock for me if it's trading on a price to sell under 3 with a gross margin of 80%. I find 80% to be the best gross margin. Sometimes, if you're operating in the physical world, in e-commerce and things like that, 50% is okay. And e-commerce is only slightly a physical world, not entirely. That's what I want for my undervalued stocks. and then I pick the highest future revenue growth from there. The issue is finding the revenue growth. It's not easy to predict future revenue growth. It's easier to predict past revenue growth, and also be wary of triple-digit revenue growth. Typically, if a stock has triple-digit revenue growth, it means it started from zero or from next to nothing. And so that's how you get sometimes with past growth on a stock having been, say, 500 or 600%. That's because the stock started with sales next to zero, and all of a sudden it's 6x. Well, you're going to have a lot of diminishing returns. The revenue growth, I want more than 30%, and it's tough. It's tough to find more than 30%. You move from a universe of stock of 8,000 stocks, and you narrow it down to stocks growing at 30% revenue growth. What is it? You have a couple hundred stocks, and then you want them cheap. So it's tough to find. Anyways, that's for the growth part. Then I like economic profitability. What I say on this is I want my companies to not go bankrupt, and you have to figure out for you what's your measure of economic profitability. Are you going to follow accounting, and what accounting tells you is a profit or not? I happen to believe accounting is mostly a religion, frankly, if you see how MSTR has been treated. But it's accounting is mostly following the rules to figuring out how to pay your taxes. And it's the accounting boards, they make the rules. That's not true economic profitability for me. I'm trying to figure it out for myself. What I use to assess economic profitability of a firm is adjusted EBITDA, not because I find it's a perfect metric, but because this metric is measured kind of the same in every single company, and it makes it easier to compare stocks between each other. So I use adjusted EBITDA, the D and the A, depreciation and amortization. You may have seen me discuss this on the channel. You know, it's like you depreciate a machine. Your machine, you depreciate it over 5 years, but it's got a life expectancy of 35 years. So really, was that phantom expense really warranted? These are fake expenses. Like you're not gonna throw away the machine after 5 years if it still works, if it is still working. There's a lot of accounting conventions that need to be added back. You remove depreciation, you remove amortization from your earnings, but you depreciate the machine because it's an accounting rule. You don't depreciate the machine because you think the machine is going to die exactly 5 years after you put it into service. Sometimes they last much longer. Anyways, that's just my point on this. I prefer adjusted EBITDA. Let me decide whether I like the assets on the company or not. Don't have an accounting board tell me what I should think about the value of these assets on the books. And you also gotta pick your own opinion on share dilution. I know a lot of people absolutely hate dilution. Believe me, whenever I cover MicroStrategy, I know they hate dilution. Personally, I've never really cared too much about dilution. That's because, some people say, sometimes managers, they'll dilute 5%, 10% a year. And they say, people are lining their books with money, their pockets with money, they're making a bunch of money, etc. Well, to me, it's less than the dollar, because I view the dollar devaluing at 15%. I view that $100 bill, I view it melting. And at the end of the year, it's going to be worth 85. And then I view it melting again. And then it's going to be worth like 73 or 74 bucks, 72 bucks, whatever. Anyways, I don't do math. Anyways, doesn't matter. It's like it just keeps melting. Your stock, in my view, most stocks do not dilute as fast as the US dollar. And people in dilution, this is what annoys me. People forget that when managers, executives, your best engineers, your best team members, etc., when they are paid via shares of new stock being issued, stock-based compensation, it saves the company cash. If there had not been dilution to pay the executives, they would have wanted cash instead. And oftentimes that's worse for the company than just giving a few shares. But this is a matter of opinion. This is not a matter of fact. As an investor, you have to decide how you feel about the dilution. Talk about another company I follow, which is CleanSpark. Look at how much people hate a company like CleanSpark or Iron. They look at the dilution. it's tough for people to understand that it's better to dilute, to get the cash in, and then you pay the electric bill, you pay the expenses via the dilution. It's more tax efficient. Sometimes there's a lot of dogma associated with what a company should do when really we should think for ourselves on these things and just have our own opinions, have our own opinions about profitability, what it means, economic profitability, have our own opinions about dilution and what dilution means. And, you see this, you see this on many aspects. Anyways, toughest part, of course, these are just numbers. The toughest part is picking a business you like, and this is when we get into qualitative analysis of a company. Well, one of the big questions you're going to have to ask yourself is, do you like a moat? And when I hear moat, I hear a company that wants to rent seek. I hear a company that wants to charge more than the market price because they have a moat. And the moat makes it so that nobody can come in and undercut them and charge less, right? So recently I've covered GLP-1s and tirzepatide, right? Tirzepatide, why do they want to say there is no shortage? Why do they do everything they can for it to be no shortage in the USA? Because if there is no shortage, then whoever makes generic tirzepatide, it's not called a generic, but you know what I mean, like a compounded tirzepatide, whoever sells a copy, quote unquote, a copy, can't undercut them. They can't undercut them. And then you get to charge $2,000 a month for your diabetes medication because you have the moat protecting you until 2031. You have that patent protecting you. Except the example of tirzepatide and Eli Lilly is the best example about moats. Moats aren't as big as they used to be. Moats aren't as strong as they used to be because the truth is, if you follow the GLP-1, sorry to just go on a tangent on this one, right? But imagine a world without internet. How could you have found a compounded version of a GLP-1 called tirzepatide without the internet, right? So without the internet, it was much easier for Lilly to sell tirzepatide at $2,000 a month because people wouldn't be doing search. People wouldn't search, right? And so of course, if you follow that field, which I do, you have a lot of people. They get on Reddit, they get on all sorts of messaging boards, and sometimes they'll just go and they'll buy the GLP-1s in Japan. They'll find the cheapest. It's moats are very tough to defend, and they are much more tough to defend in the era of flat, free information where everybody has access to information. When you have a moat, you try to rent seek. You're trying to charge more than when the competition can charge. And I believe that's a very 20th century way of thinking. The opposite of moats, of course, is 0 to 1. 0 to 1 is the idea that you have the best product, and your product is so overwhelmingly the best. It is so the best that you're going to become a monopoly in no time. And before you know it, you'll be a monopoly. Your competitors will not even have a shot at competing with you because your product's so good, because everybody's going to switch really, really quickly. That's the 0 to 1 concept. That's my explanation. And so that's why you have things like Elon Musk. People like Elon Musk tell you in an interview, oh, patents are for losers. They literally say patents are for losers. Oh, we file our patents because we want to avoid patent trolls, but patents are for losers. That's literally what they tell you, right? Because it's a form of moat. So we have to, what's the value of a brand, the moat of a brand, right? Brands used to be moat because you couldn't do an online search and read the reviews. So you needed to have memorized the brand in your brain so that you would make a quick decision at the aisle at the grocery store because you couldn't look it up, right? So that's how we have Tide and all of these brands. But today you can just look it up. So anyways, point number 2, point B here is digital over analog. To me, businesses, they need to move fast. They need to move with digital rails. Anything digital, anything intangible, I much prefer it over anything physical, anything what I call 20th century analog. You get it. So if you're going to go for retail, if you're going to go for a business that sells stuff, in my view, much better finding a business that sells digital stuff. If you can't sell a business that sells physical stuff online, and if you really can't, well, I guess you have to go with less efficient businesses, which are really the businesses of the 20th century, which are less efficient. And lastly, many deciders, this is a point that I'm slowly growing, which is the idea is it's better to sell to a million customers than to just a few customers. And when I'll get to talking about some of the health tech companies, healthcare companies, really there's only one decider, and it's Medicare. It's the CMS. CMS is the decider. And if you're on their bad side, you're not gonna be on the list. And if you're not on the list, your business is out. And so I think businesses that have many deciders, businesses that sell, say, direct to consumer, that have access to millions of deciders, I think they are much more lasting business, if that makes sense. So hopefully that gives you some foresight into what I think here, how to evaluate the business, etc. Sorry about the tangents on this one. Moving forward, talking about MicroStrategy's NAV. So what if MicroStrategy's NAV, net asset value. And of course, what they mean here is really, I should precise, is price to NAV. What if the price to NAV goes to 1, i.e., the market cap of MicroStrategy is roughly the same as the market cap of the Bitcoin on the balance sheet? Well, what could happen if that were to happen? Well, if that were to happen, option A, Saylor could technically keep issuing new shares and acquiring more Bitcoin. And of course, if he issues shares and buy the Bitcoin at the market price, there's no impact, because you got diluted, but you got diluted, but that dilution bought you more Bitcoin. So there's really no impact, unless this could still be good if Saylor found another way to generate a yield than using the delta, the difference between how much Bitcoin you acquire and how much you were able to sell your shares on top of the Bitcoin, right? Monetizing the NAV. You monetize the NAV as long as the price to NAV of MSTR is above a 1, you're monetizing that NAV, right? If MSTR trades at 2x Bitcoin, you're selling $1 of NAV for $2. That extra dollar you monetize and you add it to your balance sheet. So if you're on a 1-to-1, if your price to NAV is a 1, then how do you make money? Well, first of all, it's a neutral operation as long as the price to NAV stays around 1. But you could make money still by acquiring more NAV if you were able to generate a yield on Bitcoin. And that's what I believe will be the long-term strategy of Michael Saylor. We could have things like Bitcoin banking, that's lending the Bitcoin to entrepreneurs, to too big to fail institutions, to states. You could also make money on Bitcoin by listing it on other rails. For example, wrapped Bitcoin is one example. Bitcoin on the Lightning Network is an example. You could list Bitcoin on BTC and just make money on transaction fees like miners do. There will be ways to earn a yield on Bitcoin. We just don't have that for now. What else could you still do? So if the price to NAV of MicroStrategy goes to 1, one thing you can still do is issue, you can stop with the ATM, but you can still issue convertible bonds at a premium. You can still do that from that volatility. So even if it goes to 0, you can still earn money by issuing converts. So that's a strategy that will still be in place as long as the volatility of Bitcoin remains. And if the price to NAV is a 1, then the volatility of MicroStrategy roughly will be equal to the volatility of Bitcoin. So that's point number 2. So that strategy, the convertible bond strategy, in my view, will not be gone. And the last thing, which you didn't specifically ask about in the question here, but what if a price to NAV goes below 1? And this is something I need to develop in another video. It's simple. If a price to NAV goes below 1, then Saylor could just do share buybacks. You could just buy back your own shares and force the NAV back to 1. So anyways, I need to explore that in the video, and I'll explain my thoughts behind that in a video at some point in the future. Let me move on to question number 5 today, which is about my behavior with certain stocks. And so they ask, Palantir is clearly too expensive, yet you say you don't want to close Palantir. Well, yeah, it's clear. It's clear to me that Palantir is expensive right now. It's a clear it's a clear example of a stock that's so expensive it's ran too much. But it's not entirely true to say that I have a pattern of keeping stock that are too expensive. The reason why I say that is because I sold NVIDIA, right? I haven't sold my Palantir because I'm still hurting from my decision of deciding to take a bunch of profits on NVIDIA. I wish I still owned NVIDIA. So yeah, I feel like I want to sell Palantir just like I felt like I wanted to sell NVIDIA, and I feel like I should learn from my mistakes and not sell Palantir just yet. So selling Palantir, that's things that I dream about once in a while. I'm like, okay, that one's so expensive. I'm way in the green. I'm close to a 10x on it. But I'm not making that mistake for now. And so if I sell it, I will make a video. But if I were to sell it, I will also say it might very well be a mistake. And so in AI, I want to be careful when I put my AI lens, but I put a very different lens analyzing AI companies, because clearly selling NVIDIA, in my view, for me, for my portfolio, that was a mistake. Palantir is also squarely fitting in the AI sector. I want to make sure I don't make that mistake. So for now, it's a hold. I take a very long time making decision on this type of stuff. Yes, I have all of the red lights flashing. Everything tells me Palantir is too expensive. But I remember my mistake with NVIDIA. Also, I don't want to pay taxes. So if I can keep it my preferred holding period is forever. If I sell Palantir, I have to pay taxes, which is why if I sell Palantir, it will be next year. It won't be this year. It will be next year, right? I want to have it count for the tax year next year. Anyways, about StoneCo, you asked about StoneCo really briefly. So I wouldn't buy StoneCo today. I entered StoneCo when StoneCo was much more expensive. The revenue growth were much higher. It was not much more expensive, but the revenue growth at StoneCo when I entered was much higher, and I got caught off guard by a business whose revenue growth stalled. But the revenue growth stalled mostly because new management came in and they stopped investing in the growth and they started entering the cash pile business. And they like to have a pile of cash. And if you look at StoneCo's balance sheet, they just pile the cash. They stopped investing in the marketing. They used to do a Big Brother Brazil, and they had sponsored this #1 TV reality show in Brazil, and they were spending a bunch of money promoting StoneCo, trying to grow. And this new management team is just sitting on the cash, hoping to finance small business with the cash. I don't like the strategy. I want to sell StoneCo. It's been on my selling list, but even if you analyze StoneCo through traditional lens of business, the P is something ridiculous, like around a 5. So I don't want to sell StoneCo because it's just too cheap. I guess the feeling that I have with StoneCo, maybe the feeling that some people have with, say, Alibaba. Some people bought Alibaba in the 180s, the 200s. It's been 4 years, 5 years. They're still sitting on it because it's just so cheap. So I'm keeping my StoneCo, even though I wouldn't buy it today. I'm still keeping it, and the revenue growth has stalled. I still think the business is so unwarrantedly undervalued. And let me conclude with a last question about BioStem, BSEM. So this is a screenshot from a Motley Fool article talking about so BioStem. If you look at the price chart of BioStem, and this goes back to what I was saying about the lack of information on small companies. So AmnioWrap and Vendor have their top product. So by the way, if you're not familiar with this company is a very innovative company. They do bandages out of placenta-based bandages, and they have all of these amazing outcomes, and it's in wound care, of course, the field of wound care. Sometimes you have a wound that does not heal. They have developed this technology, which is a placenta-based wound, which is a thin layer of placenta cut in a square in a Band-Aid, and it helps your wound heal so much faster. That's the business. Their top products, their biggest sellers are AmnioWrap 2 and Vendor. These are the top sellers, and they had gotten Medicare coverage on October 15. The stock ran all the way up, and then the stock kind of crashed a little bit because they were not included in the local coverage determination. And still to this day, and what the Motley Fool says is they say that, oh, it's no big deal, they will be included again. But then again, apparently this was some, allegedly, I have no idea, but allegedly this was some sort of a paid article. We don't know. So I'm not an insider, but my problem with BioStem is that there's a handful of decision makers at Medicare and Medicaid services who kind of decide whether this product is going to be chosen or not for reimbursement. And it seems to me, the little bit that I know about healthcare is that if your product doesn't have the codes, if it doesn't have a Medicare code, if it's not in the system, the doctor then has to go out of their way to try to even think about the product. And it's much tougher to sell a product that is not decided, that has not been blessed, quote unquote, by CMS. CMS blesses a product for success, or CMS stops blessing it. Look at the story of Semler Scientific. Why did Semler Scientific get into Bitcoin? Because QuantaFlow used to be a blockbuster product, great product, until someday somebody at the CMS said, okay, well, I guess we're not covering it anymore. And then doctors just reverted back to the old practice that was free, which was an assessment of anyways, it's heart disease, doesn't really matter. They may have a much better product. Actually, the research I did a full video on this. They have a much better product. Placentas are a blessing. They really help with wound care. They have a much better product. But if it's not on the CMS, they're not going to get paid for the product, and they're not going to get adoption if it's not on the CMS. In other words, this CMS, this Medicare, just entirely messes up the rules of a free market. Because if it's not decided, then the free market's not going to adopt it, because healthcare professionals are taught to think first, it has to be reimbursed, otherwise I'm not going to use it. So anyways, that's kind of my state on it. My answer is I don't know. And if you know more in the comment section, tell me. I was going to buy it. I was definitely going to buy it. I haven't bought it. I definitely was. But I haven't. So anyways, I love the product. I think they have a lot of good stuff going on in the product. The upcoming NASDAQ listing, I think, could be a catalyst. I think it's ridiculously cheap. Look at how cheap this product is, 0.01. It's so cheap. But it also reflects the risk. This is not going to be a Q4 matter, but this is going to be a Q1 matter, which is what is the risk? It's the risk that they're not in the local coverage determination list of Medicare. And if when the list is redrafted, they're still not on it, then they will not be eligible for reimbursement under Medicare. And so it's a risk. It's a major risk. And so I will spend more time studying these companies, and I have a feeling I will eliminate a lot of companies in that sector just based on that Medicare risk. Otherwise, the numbers look so good. Forward revenue growth and BSEM predicted at 80%, gross margin 95%, 10% EBITDA margin. Look at the revenue, the revenue is what? If the company is trading at 0.4 times forward revenue predicted, it's just ridiculously cheap. Love the value. I hate the fact that it's one decision maker probably who has the life or death right on that company. I just stated. If you know more about this, please let me know. Anyways, this was not financial advice, not investment advice. This is just entertainment, and I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thanks for watching, and have a wonderful, wonderful day.